First half of the year performed well because the economy was reopening. We began the year in the early stages of an economic cycle, an economic recovery. And so you saw parts of the market and parts of the economy doing a little bit better than other areas of the market, things like energy, financials, real estate, communication, industrials. If you think about the connection between those various sectors, you see that they're early economic cycle recovery plays. Energy, because people are going to be driving more, they're going to be getting out, they're going to be going back to work, they're going to be getting out of the house and moving about. Financials, because interest rates were moving up, people were going to be trying to secure loans. Real estate, we saw the real estate market in the United States just on fire. Industrials, also another early economic cycle recovery play. People were and companies were going to be spending more in construction, and industrials. Construction is only a piece of the industrials, but companies like FedEx and UPS, also part of the industrial play, we're going to be moving more packages around. And so you start to understand that an early economic cycle would lead to an outperformance in these groups. Now, you also saw strength in other areas of the market, but these were the leaders during the first half of 2021. As we move forward, there's been a little bit of a shift. People believing that maybe the economic cycle is run its course or running its course, and we're a little bit further on. And you start to see in the second quarter, things like technology and communications start to move on up the outperformance measurement chain. With interest rates moving a little bit lower from maybe the past month and a half, things like technology stocks that were considered extremely overvalued at the beginning of the year are no longer considered extremely overvalued. And there's been a little bit of a movement back into those areas. Why have interest rates moved down? It's several parts or several reasons for that. The rest of the world is having to deal with coronavirus variances. They're not growing as fast in the United States. Some money's coming into the U.S. Treasury market. A belief that maybe inflationary pressures are not so much of an issue that we have to be worried about them, that maybe, yes, indeed, some of these pressures are temporary or transitory, as the Fed likes to call them. And that's become more evident in some of the more recent inflation reports, like the CPI and the PPI, where you've seen things like used cars and lumber and food and energy really spike up because there's a imbalance between supply and demand. As more people go back to work and the supply issues get straightened out, some of those pressures should start to be relieved. And I think the market's buying into some of that. I think what you'll probably hear from the Federal Reserve, especially as we approach the Jackson Hole, Wyoming meeting, which is in August, is the Fed start to back away from the real estate or mortgage-backed security purchases. So the Fed has been buying government paper, they've been buying corporate paper, and they've been buying mortgage-backed securities in order to keep rates low and try to keep the economy, which is, in their view, sort of still tenuous, and encourage economic growth. I think with the reduction in corporate bonds that they've announced, and it clears the sort of the runway to reduce the mortgage-backed security purchases. Now, the announcement to discontinue corporate purchases really didn't shock the market at all. In fact, the market was able to sort of take that news and move forward with it. And I think the market's going to understand that if they back away from mortgage-backed security purchases, it's probably the right thing. Reduction in liquidity in the market. They'll probably continue the U.S. Treasury purchases, at least for the time being, They may make some announcement, but I don't think they're going to make any kind of announcement on rates until sort of the second half or latter part of 2022. I think the best place to be is invested in U.S. equities. There's been a lot of interest in small caps and mid caps. I think there's still should be interest in the large and mega cap companies. I think you'll start to see, continued interest, or you'll see a continued interest in things like technology. But I think as far as we're concerned, we're looking at areas like energy, financials, technology. I also like the consumer discretionary space and selected areas of that. And I think you look for the market leaders, and I think you'd probably have a pretty decent year. I think there's still at least another 6 to 9% upside from current levels. It's been an underperformer, unfortunate for folks who have owned it. Would I be a buyer of gold here right now? Not necessarily, unless I'm extremely worried about the prospects for inflation. Everything that you're taught in school is that with all this massive amounts of liquidity, that inflation is to come. Too much money chasing too few goods and services. But it hasn't been the case. It hadn't been the case after the great financial crisis. It hadn't been the case really from the dot-com bubble. There's a place for gold in some people's portfolios. I'm not a buyer of it, and I wouldn't let it be too much of my portfolio if I owned any. I think for Didi, the timing really was the issue, because China is celebrating its 100-year anniversary for the Communist Party. And Didi didn't want to sort of step on the toes of the government by going out and doing interviews. And I think that's the only reason that particular IPO didn't work out better than it did. I do think that Didi is probably going to see a real benefit in the future. And I bought some yesterday in the open market. And I think once the celebration for the birthday of the party sort of fades away, you'll start to see the leaders of Didi go on television and being interviewed. And I think it'll probably attract more attention. I mean, it's a huge market. They're the dominant player. They're the only player. They have sort of a monopoly control of the situation. So, I mean, what's not to like? I mean, it's very interesting.